Imagine building like a wildly successful, totally frictionless digital app. I mean, you have millions of users, zero physical inventory, no rent, no real-world maintenance at all.
Right, the ultimate Silicon Valley dream. Software just scales infinitely, and you never have to buy a mop or, sign a commercial lease.
Exactly. You are living the dream. And then you voluntarily decide to take all those profits, sign brutal 10-year leases all across the country, buy millions of dollars in highly sensitive medical equipment, and actually open brick-and-mortar storefronts.
Yeah, which sounds crazy on paper.
It does. Why would a tech darling ever willingly chain itself to the heavy, capital-intensive physical world?
Well, because eventually the digital dream hits a physical ceiling. You can influence a customer perfectly online, but you can't download a laser skin treatment, you can't virtualize a medical procedure.
Right.
So the companies that realize this are doing something completely counterintuitive. They're using their lightweight software to build these heavy, incredibly lucrative physical empires.
Which is exactly what we are focusing on for today's deep dive. We're looking at a company living right at the center of that collision between a digital funnel and a brick-and-mortar reality.
Yeah, it's a fascinating pivot.
It really is. Today, we are unpacking the unaudited first quarter 2026 financial results from So Young International, Inc. Their ticker is NASDAQ SY, and we're using their official May 22, 2026 press release as our source.
And for those listening who might not be familiar, So operates as China's leading aesthetic treatment platform. For years, they were basically like a digital bridge.
Right. They connected consumers who wanted cosmetic procedures, things like laser treatments, fillers, non-invasive contouring with independent physical clinics offline.
Right. They functioned as the premier digital marketplace for the medical aesthetics industry. They owned the customer's attention, but they didn't actually own the medical clinic performing the work.
But according to this new press release, that era is entirely over. They aren't just a bridge anymore. They are aggressively building the destination.
Oh, absolutely.
So, for you listening, our mission today is to decode exactly how a primarily digital platform successfully builds and scales a brick-and-mortar medical empire, and what the financial reality of that massive transition actually looks like under the hood.
Yeah.
Okay, let's unpack this, starting from the highest possible altitude, because the overall financial health of the company presents this massive paradox.
It really does. Because the top line numbers paint a picture of just explosive momentum. If you look at the first quarter of 2026, So Young reported total revenues of 432.8 million RMB.
Right.
And to put that in perspective, that's roughly 62.7 million US dollars.
Which is a 45.6% jump from the exact same period just a year ago in 2025.
Yeah.
And looking at the breakdown, the true engine of that growth is a very specific line item. It's their aesthetic treatment services revenues. That category didn't just grow, it skyrocketed by 185.8% to 282.4 billion RMB.
They even beat the high end of their own internal guidance with that number.
Exactly. And they're generating this cash by performing actual physical services in their own branded aesthetic centers.
Right, so the revenue from their own clinics is rapidly eclipsing their historical revenue from simply running the app.
But wait, I need to push back here for a second, because I am looking at the bottom line of this exact same report, and the math just feels totally contradictory.
How so?
Well, if they are making almost double the money on these aesthetic treatments, why are they losing more money overall? I mean, the net loss attributable to the company actually widened. It went up to 49.2 million RMB, which is about $7.1 million, compared to a 33.1 million RMB loss in the first quarter of 2025.
That's true.
And even if you look at their non-GAAP net loss, which ignores things like stock-based compensation to give us a clearer operating picture, the loss still widened to 46.6 million RMB. So are we just looking at the classic tech startup blitzscaling trap here? Are they just buying top-line revenue at the expense of bottom-line reality?
What's fascinating here is how easily investors misinterpret a widened loss during a physical expansion. You really have to separate mature structural profitability from a capital-intensive growth phase.
Okay, break that down for me.
Well, a traditional software blitzscale involves burning millions on digital ads to acquire users who, frankly, might never pay you back. What So Young is doing is fundamentally different. They are converting cash into physical income-producing assets.
But a loss is still a loss, right?
Yeah.
Why is the hole getting deeper if the revenue is soaring?
Look at the cost of revenue section in the report. Their cost of revenues surged 65.8% to 251.0 million RMB. And the costs specifically tied to providing those aesthetic treatment services leaped by over 156%.
Wow.
And the reason is simple unit economics. Opening a real physical medical center requires immense upfront capital. Before you can welcome a single paying customer, you have to secure premium real estate, purchase FDA equivalent approved medical lasers that cost hundreds of thousands of dollars,
Right.
and put highly trained medical personnel on payroll.
Okay, so the costs are entirely front-loaded. You pay for the whole building on day one, but the revenue only trickles in over months as the clinic slowly fills up its schedule. It's not a marketing burn, it's capital expenditure.
Exactly. The losses at the corporate level are widening because they are actively funding the birth of new clinics. Think of each new clinic as a separate startup that So Young is incubating.
Oh, I see.
The parent company takes a temporary financial hit to get the clinic's doors open. So the true measure of whether this is a trap or a masterstroke isn't the corporate loss, it's whether actual human beings are walking through those newly opened doors.
Which brings us to the operational data. And frankly, the numbers are kind of staggering. I mean, the financial gamble only pays off if the foot traffic materializes.
And it is materializing big time. Verified treatment visits to their branded aesthetic centers hit approximately 148,000 for the quarter.
That's up from just 54,400 in the same quarter of 2025. And their active users, meaning people who visited a branded center at least once in the trailing 12 months, surpassed 213,000.
Yeah.
But instead of just throwing out an audio spreadsheet of statistics, there is one specific metric in this report that genuinely stopped me in my tracks. They track a category they call their core members.
Yes, the loyalty metric.
Yeah.
This is where the digital platform really proves its worth.
Exactly.
Yeah.
During this first quarter alone, the number of these core members grew by over 11,700. That is a 22% increase from just the previous quarter.
It's massive.
To put that in perspective, they didn't just add a few regulars, they essentially added a sold-out minor league baseball stadium of highly engaged customers in just 90 days.
And the financial weight of that specific group dictates the entire business model. Because the report explicitly states that these core members contributed over 80% of the total aesthetic treatment services revenues.
80%. And the kicker is that they have a quarterly repurchase rate of nearly 80% as well.
Which is unheard of.
Right. So what does this all mean? When I think of a standard medical appointment, I think of going in like once a year. When I hear an 80% quarterly return rate, I think of an exclusive boutique gym membership or a highly addictive airline loyalty tier. They aren't just selling a one-off facial. They're engineering a lifestyle habit.
Think about the last time you visited any retail store with an 80% quarterly return rate. It's incredibly rare. In physical retail, let alone specialized medical services, most brick-and-mortar businesses spend a fortune on local marketing, billboards, and Google ads just to get a customer to walk in once.
Right.
And then they just cross their fingers and pray the customer remembers to come back.
The traditional customer acquisition cost for an independent, standalone clinic must be absolutely brutal.
It is the single biggest point of failure for independent clinics. But So Young bypassed that entirely. We need to look at the mechanism of how they use their app. They aren't operating blind. They already have millions of users on their digital platform, reading reviews, comparing prices, and searching for specific procedures, say, non-invasive jawline contouring. The app tracks that intent.
So they know exactly who wants what and what they are willing to pay for it before the clinic even exists.
They use that digital intelligence to push a highly targeted offer to the user, guiding them directly into a physical clinic that So Young owns and operates. They remove all the friction.
Right, because the customer books through the app they already trust, walks into a beautifully standardized clinic, receives a high-quality procedure, and then the app automatically prompts them for their maintenance follow-up.
Exactly. Because cosmetic procedures aren't permanent, Botox wears off. Laser hair removal requires 6 sessions. The nature of the product itself demands a subscription-like mentality, and the app gamifies that maintenance.
It's like opening a restaurant where 80% of the tables are already booked by wealthy regulars before you even unlock the front doors for the month.
This is the precise reason management is so willing to take those short-term financial hits to build physical locations. They aren't guessing about demand. They are mapping the demand digitally and then pouring concrete to fulfill it physically.
Okay, since we know these fiercely loyal customers are out there, we need to look at how this physical rollout actually works on a timeline. The unit economics of the individual clinics. Because as of March 34th, 2026, So Young has 54 fully operational branded aesthetic centers across 16 major Chinese cities, Tier 1 markets like Beijing, Shanghai, Guangzhou, and Shenzhen.
And notice the ownership structure in the report. 53 of those centers are directly operated by So Young, and only one is franchised. They are deliberately avoiding the franchise model to maintain absolute, tight control over the medical standards and the customer experience.
And despite the overall corporate losses we discussed earlier, the individual unit economics are incredibly strong. 41 of these specific centers achieved profitability in the first quarter, and 48 generated positive quarterly operating cash flow.
Yeah, that's huge.
But there is a data table buried in the press release that breaks down the revenues by the operating duration of the centers, basically how long the clinic has been open. And here's where it gets really interesting.
Ah, yes, the phase of development breakdown. It reveals the exact formula of their business strategy.
Right. They categorize the clinics into 3 phases. First is the ramp-up phase. These are brand new centers that have been open for 0 to 3 months. They have 11 centers in this phase with an average age of just 2.1 months. And they are bringing in an average of 2.08 million RMB per center.
Then they graduate to the growth phase, which covers centers open for 4 to 12 months. They have 23 of these, with an average age of 8 months. Look at the revenue jump there. The average revenue per center surges to 4.76 million RMB.
And then they hit at what I can only describe as the final boss level, the maturity phase. Centers open for over a year. They have 20 centers in this category, averaging nearly 20 months of operation. And these mature centers are pulling in a massive 7.5 million RMB per center.
It's a crazy jump.
From 2 million to 4.7 million to 7.5 million RMB in just over a year and a half. When I first read this, I initially thought of like leveling up a character in a video game, but that's not quite right. This looks exactly like a software as a service, or SaaS, business model, just applied to physical buildings.
Oh, that's an interesting take. Explain how you see the SaaS connection.
Well, in a software subscription business, you spend a ton of money up front to acquire a customer, the customer acquisition cost. In the first few months, you are actually losing money on that user.
Right.
But if your churn is low, meaning people don't cancel, the lifetime value of that customer eventually overtakes the upfront cost, and it turns into pure profit. So Young is doing that with buildings. The initial multi-million-dollar build-out of the clinic is their upfront acquisition cost.
Yeah, I see where you're going with this.
But because the core members have an 80% repurchase rate, because the churn is virtually non-existent, the clinic's revenue compounds every month as they stack new regulars on top of old regulars.
That is the perfect framework for understanding this data. The fixed costs of the building, the rent, the lease on the medical equipment, those stay largely flat. But the premium book just keeps filling up. This data table is the mathematical proof of concept that justifies the widening corporate losses from Section 1.
Right, because the 11 brand new centers in the ramp-up phase are dragging down the overall average.
Exactly. They are heavily dragging down the current net income because they carry all the brutal upfront costs of a fully staffed, fully equipped clinic, but are only generating that entry-level 2 million RMB. But management looks at this table and sees a guaranteed trajectory. The historical data proves that if a center can survive the initial 90-day ramp-up phase, its revenue will reliably more than triple as it reaches maturity.
But let me play devil's advocate for a second. What is the breaking point of this strategy? Because building physical spaces carries massive risk. What happens if a clinic opens and just sits empty? They are still on the hook for a 10-year commercial lease and the salaries of a dozen specialized dermatologists.
Well, the breaking point would be a collapse in their digital funnel. The entire strategy rests on the assumption that the app will continue to perfectly predict and deliver foot traffic.
Right.
If a competitor app suddenly steals consumer attention, So Young wouldn't just lose digital ad revenue, they would be left holding dozens of incredibly expensive, empty medical facilities. The physical world punishes miscalculations much harder than the digital world.
Okay, so if the entire survival of the company now hinges on this physical clinic strategy proving dominant, it makes sense that the internal structure of the company would have to pivot to support it. And when we look at their income statement, you can actually see this pivot happening in real time. The older business models are fading out.
Yeah, the income statement tells a story of a company intentionally cannibalizing its past to secure its future.
Right. For instance, their information and reservation services revenue.
Right.
This used to be their core bread and butter as an online platform. It actually decreased by 34%, dropping to 80.3 million RMB.
Which is a big drop.
Huge. The report notes this is primarily due to a decrease in the number of medical service providers subscribing to their platform. And their other services revenues, which mainly consists of insurance brokerage, dropped 39.3%.
Meanwhile, the expenses required to run a physical empire are ballooning just as we'd expect. Sales and marketing expenses climbed 33.7% to 130.8 million RMB. The report explicitly ties this increase to branding, user acquisition, and payroll costs for the branded aesthetic centers.
Right.
General and administrative expenses also rose 42.5% to 84.5 million RMB.
But there is one expense line that fundamentally confused me. Research and development, R&D. For a company that started as a cutting-edge tech platform, you'd think R&D would be like a sacred cow.
You would think so, yeah?
Yet R&D expenses actually dropped by 24.2% to 24.3 million RMB. They attribute this to improvements in staff efficiency. Wait, R&D went down by almost a quarter while everything physical surged. Are they actively abandoning the technology that made them famous just to become a traditional real estate and medical management company?
If we connect this to the bigger picture, the drop in R&D and platform subscription revenue isn't a failure, and it certainly isn't an abandonment of tech. It is a deliberate, ruthless shift in their business model. They are transitioning from being an online lead generation middleman to becoming a vertically integrated owner-operator.
Okay, walk me through the difference. How does that change where they put their money?
Well, in their early days, So-Young had to spend heavily on R&D to build the software infrastructure. The goal was to connect consumers with third-party independent clinics. Those independent clinics paid So-Young a subscription fee to be listed on the app. That is the information and reservation services revenue that is now falling.
Got it.
But management realized a crucial flaw in that model. Why do all the hard work of finding an incredibly valuable, eager customer only to hand them off to a third-party clinic for a tiny finder's fee?
Oh, I see. Why settle for a 10% referral fee when you can own the building and capture 100% of the treatment revenue?
Exactly. The software is already built. The app is already functioning beautifully as an automated customer acquisition engine. They no longer need to burn millions on aggressive R&D because the tech platform has reached maturity. They've optimized their engineering staff. Now, the capital must flow into physical execution.
So they don't need independent third-party medical providers subscribing to their platform anymore, because So-Young is systematically becoming its own biggest medical provider.
The drop in platform subscription revenue is just a symptom of them phasing out their old middleman business. They are happily starving their lower-margin digital business to feed their vastly more profitable, high-margin physical owner-operator business.
It's an incredibly bold evolution. So, to summarize what we've covered in today's deep dive, we are looking at a company executing a masterful pivot. CEO Xingjin refers to it in a report as a dual-engine strategy, balancing the scale of their digital audience with the efficiency of their physical clinics. They are aggressively rolling out brick-and-mortar aesthetic centers, willingly absorbing short-term corporate net losses to fund the brutally expensive 0 to 3 month ramp-up phase. And they're doing this because they have the hard data proving those specific clinics will mature into highly profitable assets within 18 months, driven by a fiercely loyal customer base with an 80% quarterly repurchase rate.
And crucially, they are funding this massive transition from a position of deep financial security. As of March 31st, 2026, they are sitting on a massive war chest of 880.0 million RMB, which translates to roughly $127.6 million in cash, restricted cash, and short-term investments.
That's a lot of runway.
Yeah, they aren't borrowing heavily to survive. They have the internal capital to execute this physical rollout perfectly.
And their outlook for the immediate future really reflects that confidence. For the second quarter of 2026, So-Young is expecting their aesthetic treatment services revenues to jump between 112.6% and 119.5% year-over-year, reaching up to 317.0 million RMB.
The momentum is just accelerating as more of those new clinics finally graduate from the ramp-up phase and enter the lucrative growth and maturity phases.
So why should you care about all these unaudited numbers from a medical aesthetics company? Because this represents a masterclass in how a modern business can use digital audience capture to entirely dominate a high-margin physical world industry. They didn't just build an app to sell ads. They built an app to map exact human demand, and then they built the physical infrastructure to capture every single dollar of that demand.
And, this raises an important question. If a purely digital platform can perfectly map customer intent, use that exact data to physically build clinics exactly where they are needed, and algorithmically guarantee an 80% customer return rate, what other purely online platforms are sitting on the data right now to completely take over offline brick-and-mortar industries?
Wow. It genuinely makes you look differently at every single app on your phone that is quietly collecting your preferences. They might not just be trying to figure out which banner ad to show you. They might be deciding exactly where to pour the concrete for their next physical storefront. Thank you for joining us on this deep dive. Keep questioning the numbers behind the news, and we will catch you next time.